Hi, everybody. Thank you for joining us today. And today's webinar is designed for those people who thinking buying first home. Uh, Usually it's in two categories. And one, it would be newcomers who just came to country or came like several years ago, but been renting since then. And young people who probably living now with parents, but thinking buying their own house. So today, just give me 1 second. So today's agenda is, first, as I mentioned, most people thinking, if you live with the parents, so you're probably thinking, should I buy or rent? Then the second question will be, once you decide, oh, I want to rent it, or I want to own it, so how much you can borrow, so how big house I can be qualify for. So for that, you would need the pre-approval. So you need definitely get your down payment, and you need to find your home, and that's adventure by itself. Then you need to understand what is mortgage. So what kind of mortgage want I get, and they close the deal and live happily ever after in your house. So yeah, first question which I mentioned is renting or owning. And there is no easy answer to this question at all. Well, benefit of owning, definitely. I always say that people ask me, oh, should I own or rent? I always say, you know what? It's two things. One, it's your lifestyle. It's a home. It's a place you live. That the place will be surround you for a long, long time. And the second, it's investment. So you're buying your lifestyle. So you're buying the building, you're buying in a townhouse, or you're buying in a rural area. That was lifestyle for years. Then, yeah, you definitely get the greater privacy because you decide what's going to be in your house. You build in your equity because prices usually go up. Even though the real estate is any investment, it go up and down, but most of the time and over the time, it always goes up. It's a sound investment, so it doesn't fluctuate like risky stocks and bonds. So you're building slowly but surely, and it's freedom. So you can decorate your house whatever you want, especially inside, and you improve your credit worthiness. Like now we have a personal loan campaign, and homeowners have much more chances to get bigger loan and a better percentage. So it definitely has its downsides as well. So it's a commitment. So you buy a house, it's not easy to change it because you invest so much money. It's not easy to recover them when you sell them. And that's your home. You're responsible for this. It's ongoing maintenance costs. So you have to, if something breaks, roof or toilets, you have to fix it. They put your money in. Mortgage payments can be higher than rental, your rent. Building equity can be slow because it's a rule of thumb. You can recover expenses because there will be expenses, and we'll talk about later today. To the legal expenses, the taxes you pay, everything. So to recover them from the growth, especially on the slow market, it takes years, sometimes it's 3-5 years until you can sell it for profit. And less disposable income left after that as a result. Benefits of renting, it's cheaper. So the rents usually for the same thing is cheaper than mortgage and property taxes and hydro and everything. It's a flexibility. So especially in the era Airbnb, you can live here and there, and the longest lease agreement for a year, and then it's month to month, so you can change if you wish to. Little or no maintenance, because if something breaks, you call landlord. And it's financial freedom. As renter, you can likely have more free cash for investments, or you can contact our wealth management to invest it in mutual funds or stocks or bonds. But yeah, it definitely has its downside. You're not building your equity, so you're just paying to landlord. And landlord, your boss. They say you can have pets or you cannot have pets. You can do this, you cannot do this, and instability. So you don't know what's going to happen. So how to decide? Where do you want to live? Before that, you need to sit down and calculate, look at your budget. So look what you have, what's your goals, where you want to live, where you work, so how far will be your transit. Is that okay with you? Do you have enough money? Yeah, and you can see as a rule of thumb, if you pay more than 3,000 in rent, so looks like it's definitely you better buy a house. But other than that, yeah, you need to sit down and think. Once you decided, no, I really want to be a homeowner. I want to have my house. I want to build my equity. I want to have the place I decide what to do with this. Yeah, you definitely need to calculate your monthly expenses. Think about what you can afford, as I mentioned. Uh, See how much you already saved, what's your options are for the down payment, decide your maximum house price. Okay, uh, can I buy for 1 million, 10 million, or just 500? What's my range? Understand the mortgage pre-approval process, and don't forget about the additional costs. It's not just down payment. So the steps involving, yeah, first I would recommend, and usually real estate would recommend you to do, just get a mortgage pre-approval. Just go to your financial institution like Ukraine Credit Union, see me or any other lender, and ask, so how much I can afford? Look at my situation and tell me. So I'm not the dreamer just wasting my time looking for something. Then you tell me, oh, you don't qualify for that. Uh, then find a real estate agent you trust and which can help you find your home. Search for home with your real estate. Find a solicitor because solicitor needs to review your papers. Make an offer, negotiate, fight for the price, fight for the options, and get acceptance of the offer. Once you get your house, usually people put the conditions on the offer, and you may want to do inspections. The financial institution definitely will do appraisal because we need to know what's the fair market price, not the price you're willing to pay, but what's the fair market price. And contact the Ukraine Credit Union if you're going with us to finalize your financing once you know exactly what the house you purchased. And yeah, get the closing, get your keys. What's the mortgage pre-qualification process? So wherever you go, whatever Ukraine Credit Union or another financial institution, they would say they ask you the same questions. So what's your down payment? How much you saved? So what is that will limit you on the amount of mortgage you can get and the price of the house you want to buy. What's your income? Because you cannot buy the 10 million house, which your payments will be 5,000 if you make 2,000 per month. So your income will limit the maximum amount of mortgage and the price of the house you can afford. Then what's your credit history? What's your scores there? What's your current assets and liabilities? So what you stand on, and what kind of property you want to look for, because the financial institution has to calculate what probable expenses may be there, so they can tell you, okay, you're probably okay for this type of house. So what about down payment? So that's a start. So down payment is the amount of money that you pay at the time you purchase the house, and the rest will cover with the mortgage. And that's a big question. So how much I can should I put in the down payment? So there is two types of the mortgage in Canada. We call it conventional, when you put 20% down or more, and you borrow the rest. So then you're dealing with your financial institution. Or the second type, high ratio mortgage. So if you don't have 20% down, you have less. So that considered to be a risky mortgage, and it has to be insured. So, but again, you cannot buy the house with a zero down payment. So it definitely it's first it's your savings, but most lenders will accept down payment fund as a gift. Let's say the children buy the house and parents or grandparents giving you some cash. Is that acceptable? Yes, it is. But yeah, you need to provide the proof. Usually it's a letter of gift letter saying it's not, money is not land, but the money is given as a gift. And you can see the little thing. It says the minimum down payment. So if you buy a house under 500, even if it's high ratio mortgage, uh, then you can put the 5% down. So if the house price between 500 and a million, then the minimum down payment calculates as 5% for first 500 and 10% for the rest. And if you buy a house for for a million or more, you have to have 20% down, because unfortunately this mortgage is not insurable. So some tips how to save for down payment. So first of all, yes, pay to yourself, because so many things going on in our lives. We want to do this, we're going to go on a vacation, but then there is no money left. So if you set up the automatic plan, which let's say you get your paycheck on the same day, you put down aside 100 on the savings account or GAC or RRSP or TFSA. So then in time you get some amount of money. If you get some cash bonuses, commissions, tax refunds, don't just spend them. Just put them on the same saving account. Save it for your down payment. Build your basic budget. So very often people, if you sit down and fairly look at what you spend on, you can say, oh, instead of 3 coffees, I can drink 2 coffees. So 1 coffee, I can save money, put aside. And this little savings can grow to big savings and to your down payment. And last not least is contributing to your RSP. So RSP is a great vehicle to save for your down payment, and you're not paying taxes on the money you're saving there. So it's a little example, because I mentioned the high ratio mortgage, you have to pay insurance, and insurance cost is quite high. So you can see the house approximately 450. So you put the down payment as different options: 5% down, 10% down, 15% down, 20% down. So in first case, so CMHC insurance, you can see. So the less you put in down payment, the higher the insurance will be. And the next line shows amount saved from 5% down, because you pay less of the premium on the mortgage. So your mortgage payments will be less because your mortgage is smaller. Definitely your payment is smaller. It shows the savings you have. Interest. So basically, when it's insured, so usually you put the insurance cost add to the mortgage, and you pay more interest. So you can see when you put down, it's 157. If you put 10% down, the interest you pay over time, 148. If it's 15% down, 139. So you pay a lot of money on the 450 house as an interest over time. So the savings are maybe very, very big if you save for your down payment. So what you need to remember when you use your RSP. RSP can use the first time home buyer, but really what government says, they allow you to take money from your RSP if you didn't have a house for 5 last years. So basically, if somebody had the house in the past and then sold it, and for 5 years I never owned a house anywhere in the world, then I can use it again, and they consider you as a first-time home buyer. So each borrower can take 25,000 per calendar in calendar year from your RSP. So if it's a couple, so definitely you can take up to 50,000. Sometimes it's three people co-borrowers, so it could be 75. So it's a lot of money to put in down payment. So it's a great vehicle because, as you know, all contributions into RRSP are not taxable. So you basically lower your taxable income and save up to 35, 40% of the income you make. Then you have to repay it back into RRSP over 15 years. So if you consider this option, so a lender, you can discuss the options with the lender, with the specialist. So yeah, what's the pros and cons? So if you take from RSP, you can get a bigger down payment, because sometimes people say, oh, I have some savings, but most of my savings tied to TFSA or RSP, and it's not easy to take it from RSP. Yeah, you can have it. Larger down payments, so yeah, you don't have to pay the default insurance, which I mentioned before, and larger down payment definitely means lower mortgage and lower principal interest payments. Yes, disadvantages, yeah, you basically taking money out of RSP, and that's your retirement money. So you have less money into your RSP by your retirement, because you basically taking off growth from the investment vehicle. You need to repay it over 15 years. It's not like you took them and that's it. And a failure to pay back will cost paying the higher taxes in the year you fail to pay down. Okay, so what's the mortgage default insurance? It's several companies. You probably heard about CMHC or Genworth and other companies we have in Canada. So that basically ensures the high interest, high ratio mortgages. It's in benefit of financial institution, not you. It's in case somebody in the future won't be able to pay mortgage back, and when they sell a house, there will be a deficit. So let's say the mortgage is 500, but the house was sold for 400, so 100 is difference. Then the insurance will cover this amount, but you have to pay that. Debt service ratio. I mentioned the income, and the income, yeah, you can see the gross annual income down below in the equation. So how they calculate it. So the normal ratios must be GDS, which is gross debt service, a ratio of 35%, which means basically all your shelter expenses, so all your expenses for the house divided into your gross annual income have to be not more than 35% of your income. And total debt service ratio, it's basically the same amount of expenses as in the first ratio, plus all other debts and obligations, like your leases for the car, for payments for the balances on the cards, so your loans, all these payments you have to pay over time. And all these, all that expenses divided into your annual income cannot exceed 42%. So if you put less than 20% down, it's high ratio mortgage. It has to be like this or smaller, because otherwise they wouldn't approve the insurance, and that means you won't get the mortgage. But if you deal with, you put 20 or more percent down, that can be flexible. So you can talk to your financial institution on your options. Next, very important thing is your credit history. So basically, credit history. What is credit history? It's your history with the financial institution. So if you've been a Ukrainian credit union member for 5 years, 10 years, 20 years, you have lots of business with us, your payment coming. So we know who you are from financial side, so we can trust you or something. If it's somebody from the street, well, we don't know you pretty much, but then it comes the credit report handy. So it's the credit report basically includes everything, like all financial institutions report to some agencies on your debts, on your payments, how you responsible, and then they calculate that tricky score. So the main score, it's a beacon score. You probably heard about that. It's represent your credit worthiness. So basically, simplify that. It's a probability of the person default the next 24 months. So you can see the pie chart. So very quickly, it's between like 350 to 950, and 35% of the score, it's from your payment history. So if you pay as a clock, every time you pay on time, then 35% of the score is yours. If you were late at some point of time, they will take it out of the score, so it will lower it. So the second big piece is the current debt. So one thing, I have, let's say 10,000 available credit, and I use just $100 per month. So which means I utilize my credit very small, or I take all 10,000. So probably I am in trouble. If something happens to me, I won't have any room to borrow money from. So I'm more vulnerable. I'm more risky. So the less your current debt, so the better score, so the higher score. The less available room, so the lower score. Because if something happens to you, yeah, you're in trouble. So the next is, you can see the 15%, it's age of accounts. So one thing, if I got my first card 3 months ago, or I had my credit cards and loans for 20 years. So definitely for 20 years, well, we know you for 20 years, we know your character, you know you're paying. If you get your debt like 3 months ago, I don't know. Like, I don't know what may happen. So what your action will be if something happens to you. Then you can see it's a type of the credit you have. So one thing, you have mortgages, car loans. So you need car to drive to work. So you need mortgage to have a house to live in. Or another thing, you have risky no-name cards, credit cards, and they up to the limit. So yeah, it tells about your character as a borrower. And credit inquiries. So one thing, if I didn't go to any financial institution for a long time, I didn't make any inquiries. And other thing, if person goes one credit union, another bank, another bank, another bank in 1 month, it may indicate you're in financial trouble. So if lots of inquiries in my bureau, it may suggest something going on in my life, and I'm probably more risky person. So once they look at your down payment, once I know your income and probable expenses, once I know your good credit, so then my question will be, okay, so where are you going to live? Because different places, the different expenses. So generally speaking, it's a 4 type of how they say the human settlements: urban, suburban, rural, and exurban. So urban area, it's like GTA, like Toronto. It's usually it's over 1 million or at least 100,000. So it's a city you live in, you work in. So you just commute within the city. It's pretty close using your car or public transportation. It's a big city. Suburban. So lots of people say, you know what, it's too busy there. I will leave outskirts, but they still work in the city. So usually outskirts is between 10,000 to 1 million. Yeah, Mississauga, Brampton, Markham, you name them. The next is the exurban. Lots of our members live in the commuters towns like Milton, Georgetown. So they don't want to live in a busy place. They don't want to experience all this stuff. They want to live closer to nature, but still be in the community and not far from the place you work. So yeah, you can see our highways. People living in Milton or Burlington or Rockville, they commute every day to Toronto. Well, but their houses is pretty much bigger, maybe a lake shore. So you enjoy your lifestyle, but you have to commute to place you work. The rural areas, it's settled places outside towns and cities. So it's not dense. Some people like to live, with the nature. So you have lots of land, probably forest, lakes. Uh, but yeah, you have to drive to the city. And that's a different approach that financial institution will take to those type of properties. So by ownership, so people think, okay, real estate, that's so many different type of ownership. So the first, property owners associations, homeowners associations, country clubs. I don't know if you heard, we have an Ukrainian community. We have Poltava Country Club. It used to be the Property Owners Association in Hoxton, Sokole. Um, it's lots of different type. Uh, the What's the specific? You don't own real estate in those places, so you basically you buy the membership, and that membership allows you to do something. Let's say build a house or own the house, use common elements, but you do not own the real estate itself. You can use it. It's most of the time it's exclusive use, and it's pretty nice, and it's tight communities. But you do not own real estate. So the second type, you can see the cooperatives or co-ops. You probably heard about them. The price is much lower. Uh, it's very similar to what I just said, but usually it's a building. So it's a building, you buy the apartment, the suite in the apartment. So it's owned by corporation. So when you buy, you're not buying actually the apartment, you're not buying a suite, you buying a share into corporation. So corporation, the co-op, owns the land and owns everything, the building, all apartment, all house in the building. You buy the ownership, and with ownership, you buy exclusive use of that place. Yeah, we have lots of Ukrainian co-ops and just multicultural co-ops in Toronto. Actually, interesting fact, in New York City, it's a 30% of all real estate is co-ops. Condominiums. Actually, co-ops existed before condominiums were kind of invented. So condominium, it's a kind of mix between what I just mentioned and the following type of property. So you own a unit, so you own that place. So it's a real estate. You can sell it, you can buy it, you own it. You decide what's inside, but you share the common elements. So the walkways, the fitness, gym, pool, the parking lot. So those elements are commonly shared, but you own your own unit. So you can sell it and buy it, as I mentioned. And freehold ownership. So freehold means everything is yours. The land, and condominiums, the corporations, the condominium owns the land which the building stands on, but unit itself you own. So in the freehold ownership, you own everything. You own the land between borders, you have the house, everything on that land. So that's kind of most of ownership you can get. And definitely within the ownership can be different, but the type of the architecture can be different too. So it could be, it could be a building, it could be townhouse, it could be a detached house, it could be semi-detached house. So usually freeholds, it's a detached house or semi-detached, it's separate buildings on the land, or it could be townhouses. So the land on the townhouse itself belongs to you. The front yard, backyard is yours, but you're sharing at least two walls. the townhouse also can be condo. So then, let's say roof, windows, the front yard, the backyard is a common elements. And parking lot, let's say for visitors or for you, that's a common elements, but the building itself is yours. And condo may be apartments or units in a high-rise or low-rise building. So that different type of architecture. And that's, you have to decide what's your lifestyle. What do you want to live? You want to live in a rural area in a detached house with lots of land. You want to live in a urban area in a house or in a townhouse or in a low-rise building, on a high-rise building. Would it be co-op? Would it be condominium? Would it be owners association? So that's all will have huge impact on the mortgage pre-approval process and the interest rate you get, all the requirements you need to get your mortgage. So now quickly talk about the mortgage, basics of mortgage. I cannot talk about many details. You can see me or any lender at Ukraine Credit Union discuss in details, but I just want to give you some basic knowledge. So the mortgage is a loan secured by real estate, the property you pay off. And that's the consequences. The first two properties which I mentioned, like country club or property owners or the co-op, you cannot get mortgage because it's not real estate at all. It's a shares. But we call it mortgage still. The rules usually for the pre-approval process applies the same, but legally it's a loan, but secured by your share and that property. For condos, for detached houses, for freeholds, it's a loan. It's real estate. So you take the mortgage. It's secured by that real estate or shares in the property, and you pay off over time to zero. So down payment. So down payment, as I mentioned, it's a money, your money. It could be from different sources, but that's what you put forward, which is not mortgage. People ask the question fixed and variables interest. So what is it? So the fixed interest rate is basically you get the rate and we guarantee you the rate, and you guarantee to financial institution the rate during the whole period you signed the contract for with financial institution. The variable rate mortgage, on the other hand, may be fluctuating at some rules. So usually it's a prime rate. You probably heard about the prime rate. So UCU has a prime rate, and it may be plus minus to that prime rate. So if the prime rate changes, your rate changes too. So that's kind of more riskier. Amortization period versus term. So what's amortization period? Amortization period, it's a time you pay your mortgage from the very top to the zero. So usually it's at 25%. Oh, sorry, 25 years, especially if you put less than 20% down. So then it must be 25 years or less. If you put more than 20% down, some financial institution will allow you to do 30 years. And in very exceptional cases, it could be even more. And mortgage term, on the other hand, it's a time you sign contract for. Because in the United States, you actually get the mortgage for whole amortization period. So they have mortgages for 25, 30 years. That's insane. But in Canada, you get the term. It may be 1, 2, 3, 4, 5 years. Some banks offer 10 years. We offer 1 to 6 months to 5 years. So you sign, if you take the fixed mortgage, rate mortgage, then that rate will be guaranteed for that term. If you take the variable mortgage, that rate will fluctuate for that period of time. Open versus closed mortgages. Some people say, oh, what is open closed mortgage? Open mortgage is a mortgage when you can prepay any amount, anytime without any penalty. So let's say I bought a house and I want to sell it in 6 months, so I don't want to tie myself in any uh, time frame. So it's open, so I don't want to pay penalty. Closed mortgage, so you have to follow certain agreements, some conditions, but the rate on the closed mortgage will be much lower than an open mortgage because it gives more guarantees for the financial institution. But the closed mortgage gives you freedom as well. So you can prepay up to 15% down. So what is 15%? That's a lot. So you have a mortgage for $1 million. So that's 150,000 you can put extra toward your mortgage per year. If you have 500,000 mortgage, you prepay 75,000 per year. That's a lot of money. Not many people have that much, but sometimes you get the inheritance bonus, so and want to prepay. So, but that's your limitation, 15%. And closed mortgage also allows you to increase your payment. So let's say your payment $2,000 per month. You say, oh, I want to increase it to $3,000. We will allow you to do up to 100%. So your payment $2,000, you got good job, so you can increase it to $4,000 to pay your mortgage much faster. So payment frequency, people say, oh, should I pay monthly, semi-monthly? So we allow you 4 options: weekly, bi-weekly, semi-monthly, and monthly. My suggestions always tie to your frequency to your paycheck. So if you get your paycheck weekly, make it weekly. You get your paycheck bi-weekly. I get my paycheck bi-weekly, so my mortgage payments come bi-weekly. So that's easy. Semi-monthly, some people get paid semi-monthly, some monthly. Self-employed people, they want to do that monthly, so that's the way to go. Closing cost. Yeah, we discussed the down payment, the mortgage, everything is clear and understood, but to buy the house, you will experience lots of other costs. And usually the guideline is between 1.5%, 4%. So if you buy a house for $1 million, so probably 15,000 to 40,000 will be your closing costs. So you have to have extra cash to fill this, to cover all this. So what's included? So you can see on the right hand side, a little breakdown, your kind of expenses, different parts of Ontario, and on the left hand side, some, but not all closing costs you may experience. The biggest part is land transfer tax. So Ontario government wants to get the share when you buy a house. And to the second line, Toronto wants even more. They want double your land transfer tax. Real estate lawyers fee. So when you hire the lawyer, so lawyer wants to get paid, plus the lawyer has lots of disbursement. They have to register mortgage, they have to register this, that, fax stuff, email, prepare the letters. You get the title insurance. That's important part too, and most financial institutions will make it mandatory, the title insurance, because when you buy the land, somebody from the past may actually claim that that land is theirs, not yours. So, and you're in trouble. So the title insurance basically covers all costs to fight that if it would be challenged in the future. Fire insurance, if your house burns down, so well, you know, it has to be replaced or compensated. And yeah, you can see those. The status certificate, when you buy the condominium or co-op, you always get the status certificate. Appraisal fee, we have to appraise the house unless it's high ratio mortgage. Some people do the technical inspection because they want to know from the specialist their house in the sound technical, in the architectural, the structural condition. Okay, I know it's lots of to ingest, and I would be really happy to answer questions. There's a few questions right now, or you can contact me or any other lender after this webinar and discuss your particular situation. So thank you.
All right, thank you, Vlad. I have a couple of questions here from people, so I'm going to read them out, and hopefully you can answer them. So the first one is, can someone withdraw from an RRSP for both the home buyers plan and the LLLP simultaneously? I'm not quite sure what the LLLP is. Maybe you can define that.
LLP. Can that person, because I'm not sure I understand what's LLP. TFSA or DRSP?
No, I think it's something similar to the home buyers plan.
That's the maybe land transfer tax thing. Yeah, I guess I hear the question, but it's different programs. It's completely different programs. So the home buyers plan from CRA, which allows you to take 25,000 from your SP. So one thing, and discount on your land transfer tax. That's another thing. The RSP withdrawal you do with your financial institution you have your RSP with. And yes, you can do that at the same time. And you do it, people do it at the same time. And lawyer will process that land transfer tax refund from the government. Because that's another program which exists in Ontario and Canada. When that's your first home, like I mentioned, RSP, you cannot have house for 5 years.
Vlad, I think so. Sorry, the person clarified. They're saying it's the lifelong learning plan for education. So I guess the question is,
okay.
Can you withdraw from both of them at the same time from your RSP?
Yeah. Okay. Now I got it. Okay. So yeah, that's two different programs. You can do them independently. So yes, you can take from your RSP for home buyers plan and for learning plan. So that's nothing to do with the buying house. It's going to university. So the adults can take money from their RSP to pay for tuition, and then they pay back over 10 years after. So yeah, you can do that.
Okay, so now there's a couple of questions that I think are related. One is, does a loan pre-approved letter guarantee a mortgage? And I guess there's a follow-up question, how long is that pre-approval letter valid for?
Okay, yeah, so we call it commitment letter. So basically that's the agreement, that's a contract between financial institution and you. And actually the commitment letter, it's we guarantee you your approval for 6 months. The rate will be guaranteed for 3 months, but the approval itself for 6 months.
So once we've decided that you're a credit risk and you got that letter, you've got 6 months to decide to buy your house.
Okay. Yeah, so you can go buy your house. If it's within 90 days, then everything, rates, all approval are guaranteed.
Okay. And how expensive is mortgage protection insurance, and who should pay it?
Yeah, so you saw an example in one of my slides. Yeah, everything pays the borrower. And but it's a bad news and a good news. So the more down payment you put into your purchase, the less percentage. Because what that insurance company wants they charge you percentage of the mortgage. So if you put 85% or between 80 and 85, let's say, they charge you 2.8% of the mortgage. If you put between 90 and 85% of the purchase price, you pay 3.1%. If you put less than 10%, but more than 5%, it's a 4% of the insurance. And if you use non-traditional, I did mention that, a non-traditional down payment, which is borrowing for the down payment, then you have to pay premium 4.5%. And you can calculate what it would be. It's a lot of money. So for 500,000 mortgage, it's $25,000.
And that premium just gets added on to the amount you borrow
Yes.
right at the beginning, right?
Yeah, you have a choice. You may pay it, and in my long practice, I had just two cases when people want to buy upfront, and most people add it to the mortgage because if they don't have down payment, more down payment, they don't have money to pay this premium.
Right.
So yeah, you can add it, but this premium you have to pay HST on it, and HST cannot be added. So HST you have to pay from your own pocket.
Okay, so the next question is, if I'm not ready right now to buy a house, but I'm planning to do it in the future, what do you suggest I may do now to increase my chances to get a mortgage once I'm ready?
Yeah, so yeah, it comes from what I said during this hour. So first of all, yeah, save your down payment because the more you save, the less your expenses will be. The bigger house you can afford, the less you will pay. If you can save 20% down, it's excellent. So start now saving. So analyze your budget, start your RSP, save, save, save. The second thing, yeah, yeah, income. So well, but income that's a job you have or your business you develop. And the third, very important thing which you can control is your credit history. So if your credit history is not excellent and then you know it, so that probably you have to improve it based on those factors I described. So you pay on time, you don't use all your credit. Uh, the longer you have that credit history, the better. So you start controlling your credit history because the better your credit, the better chance for you to get the mortgage and better rate for this mortgage. Thank you.
Yeah, I think one day in the future you should do a presentation on credit rating. I think it'd be very interesting to people on how
Yeah, I would
how they
love
can
to.
how they can manage their own credit rating and improve it or avoid making it bad. Okay, so and I think you probably did address this during the presentation, but someone's asked, can I borrow money and then use that money for my down payment?
Yes, and I mentioned when I was answering about the cost of insurance that it costs non-traditional. You can borrow it, but that payment and that debt will be included in all ratio calculations. And as a rule, it's usually killer for the ratios. It's killer for your pre-approval. So theoretically, yes, you can use. Some people do, like especially if it's not far from 20% down. So in order to save money on the default, mortgage default insurance, you borrow it, it will cost you much less than, but you still have to qualify. Those ratios has to be in line. But the answer is yes.
And am I right to assume that if you borrow that down payment, you're likely going to have to borrow it at a higher rate than what your mortgage is at?
Yes, it depends. Again, if you have stellar credit history, you know, stable income flow, that probably the rate will be the same. But yeah, you're right. So if your situation is shakier, because the rate depends on the risk that financial institution takes when they give you the mortgage. The higher risk, the higher rate. The lower risk, the lower rate. So my suggestion, answering the previous question, make yourself less risk.
You got it. Now, question about TFSAs. If a down payment is taken out of your TFSA savings, how long does it have to be in the plan before removal? Is there some limit? And can you recover that TFSA room and contribute back at a certain point?
Yes. So the rule of thumb for any type of down payment, money has to be there for 90 days. So whether it's TFSA or RSP or just savings account or GAC, it has to be there at least 90 days. TFSA, that's a plan. When you take from RSP for the plan, yeah, you save the room. But if you take from RSP for whatever reason, yeah, you lose the room. TFSA, that's a great plan which basically when you take money out, your room is there. It stays there. So you don't lose it for any circumstances. So the answer, yeah, you can take it 90 days. You don't lose your room.
That's good that you addressed that. I think a lot of people with TFSAs, there's still a lot of confusion with people that, you know, there's a maximum that you can contribute, but once your TFSA grows to a certain point and you withdraw money, you can recontribute the following year up to that limit that it grew to. So
absolutely, yeah,
that's one of these things that people don't use. So TFSAs are quite a
it's a great plan. It's a great plan.
Okay, and at the moment, if anyone else has questions, please type them in. And there's one more that I have so far, and that is, how do I know if my credit history is good enough?
Yeah, so you saw the breakdown. So the best thing is, yeah, come to a financial institution. When you apply for any type of loan, so you would, the financial institution will pull out a credit card. They pull out your credit history. So talk to the lenders. So ask the questions like you just asked me. But is a rule of thumb, as I mentioned, so your credit beacon score has to be over 680, 700s, 800s. So then it's a good enough. So if it's lower than 650, 550, that's really bad. And probably financial institution wouldn't be able to help you with the mortgage. But yeah, the second is some agencies, some institutions offer control your credit history. So you pay $20, I believe, and you can get your credit anytime. And another thing which people don't know, the agencies, the credit agencies must provide you for free with your credit report, the full credit report. It's actually even fuller than financial institution gets, once a year. So once a year, you can request from Equifax or credit union your credit report for free, and they have to provide you with the report. That's the answer.
And you just call their
well, they will
service
ask
number?
Yeah, they will ask you. They will ask you for proof that's you. It's a couple documents, the same as any institution will identify you, and then they will provide you the report.
But can you do it over the phone, or do you have to like mail them something?
Well, I haven't done that for a while. I have done it like a few years ago, and it was over email. Yeah, and you can request it over the phone, but they would request the fax or email the proof that's you.
Okay, and I'm going to ask, there was one final follow-up questions on the TFSAs, and after that, I think that's it. Do you have to wait a full year to recontribute to TFSA, or is it as of January 1st of the next year that you can put the money back?
Yeah, that was a big confusion when they just introduced TFSA, because law doesn't limit you when you recontribute, but I would not suggest to do it the same year. Why? Because when you take money out, the financial institution you take money out from, your TFSA, reports all your withdrawals once a year. But when you put money in, they report it right away. So what CRA, the Canada Revenue Agency, sees, let's say I put the whole my limit in my TFSA and made the withdrawal in March and then put it back in August. They don't know you'd made a withdrawal. All they know, you put extra money. So they believe you over contribute. So they start penalize you. Then you can, talk to them, and it takes lots of time to prove that wasn't mistake. And we had lots of cases like this. So their advice, my advice, never recontribute the same year.
So wait till January 1st or January 2nd and put it in then.
Absolutely.
Yeah, I think that's what my advisor says, the same thing.
Yes.
So that makes sense.
to avoid this dispute with CRA, which nobody wants to have.
Of course. Okay, Vlad, do you want to put up your contact thing? Because that doesn't seem like there's more questions. So I just want to thank you and everyone who's attended. If you have additional questions, Vlad can be reached at 416-762-6961, extension 138, or you can email him at vkarman@ukrainiancu.com. We will be placing this recording on our YouTube channel either later today or tomorrow when it's ready. So if you missed something, you can re-listen to it, but feel free to contact him directly and he can answer any additional questions that you may have, or contact a lender at your local branch and they'll be able to help you as well. So thank you very much, Vlad. That was very thorough. You always
thank you.
Have a lot of good information, you know, things that people don't often think about, but are very important for to know if you want to have peace of mind when you're buying a house, which is probably the biggest purchase any of us are going to make. Anyway, thank you very much. We'd like to see you guys again at our future webinars. Visit our website to find out when those are. Have a good afternoon.